You bought the stock and it did nothing. It just sat there, day after day, a dead weight in your portfolio. You checked it constantly, watching the price tick up a few cents, then down a few cents, going nowhere. It felt like watching paint dry, only the paint was your capital, and the wall was your financial future. You felt the itch of impatience, the whisper of boredom. You thought, this is a waste of time. I need to be in something that's moving. So you sold it, probably for a small loss or at break-even, just to free up the cash and escape the agonizing stillness. And then a week later it began to move, without you. It climbed, first slowly, then with an undeniable force, day after day, until it had doubled. The frustration you feel is not just about the lost profits. It is a deeper, more personal sting. It is the feeling of being outsmarted by an inanimate object, of being perfectly wrong. You were in the right room, but you left just before the party started. This painful experience is the price you pay for ignoring the single most important principle of speculation, the line of least resistance. The market, like water, will always follow the path of least opposition. It does not care about your hopes, your analysis, or what you believe a stock should be worth. It will flow where the pressure is weakest. Your job is not to predict, not to command, but to simply identify that path and align yourself with it. When you buy a stock that is stuck in a narrow trading range, you are not speculating. You are wading into a battlefield. On one side, there is a wall of sellers pushing the price down. On the other, a floor of buyers pushing it up. The price is trapped between these two forces, a prisoner of war. There is no clear line of least resistance. It is a zone of maximum resistance. Entering a trade here is like trying to push a boulder uphill. It requires immense energy for very little movement, and the moment you relax, it can roll right back over you. The novice trader is addicted to this struggle. He sees a stock that has gone sideways for months and thinks it is due for a move. He buys it, and when it doesn't move, he grows impatient. His mind, unable to tolerate the quiet, invents reasons for action. He convinces himself that his capital is being inefficient. But true efficiency is not constant motion. It is decisive action at the correct time. A patient speculator understands that this sideways action, this congestion, is not a waste of time. It is a period of preparation. It is the market drawing a deep breath before a sprint. A great coiling of a spring where energy is being accumulated for a powerful, directional move. To trade inside that coil is to be crushed when the energy is finally released. Your role is to wait, watch, and act only when the direction of that release becomes clear. The line of least resistance is not a guess. It is an observation. It is the moment the stalemate is broken, when either the buyers or the sellers have exhausted themselves and the opposing force takes control. To act before that moment is to gamble on a coin toss. To act after is to ride a powerful current. I remember a time in the wheat market many years ago. The price had been stagnant for the better part of a season. It was trapped in a narrow channel. Every day the newspapers and the so-called experts were filled with conflicting stories. One day reports of a drought in Kansas would cause a flurry of buying, pushing the price to the top of its range, only to be met by a wave of selling. The next day, news of a massive harvest expected from Argentina would send it plummeting to the bottom of the range, where it would find just enough buying interest to hold it up. The crowd was bewildered, whipsawed back and forth. They were buying on good news at the top and panicking on bad news at the bottom, losing money in both directions. They were fighting the resistance. I did nothing. I watched the tape. My screen showed a market at war with itself. There was no trend. There was no path. To enter would have been a fool's errand. My capital remained in cash, a patient sentinel. I wasn't interested in the news about the weather. The tape was telling me the only truth that mattered. The big interests were in a deadlock. For a speculator, a market with no clear trend is a market to be avoided entirely. It is quicksand. Then, after weeks of this frustrating churn, the character of the market began to change. On a rally attempt, the selling pressure seemed lighter than before. The price did not snap back down with the same violence. It held its ground near the top of the range. The volume on the up days began to quietly increase, while the volume on the down days began to shrink. The tape was whispering a secret. It was telling me that the sellers were becoming exhausted. The supply that had formed the ceiling of that range was being absorbed. Then came the day. The price pushed through the old top of the range. It was not a violent explosion, but a firm, decisive move. And it held. It closed above the line of resistance. The next day, it did not fall back. The path of least resistance had finally clearly been established. It was upward. The stalemate was broken. Only then did I act. I did not need to know if the drought was real or if the Argentine crop had failed. The market action had told me everything. The buyers were in control. The river had begun to flow, and my job was simply to get in my boat and ride the current. The profits from that single patient trade, a trade based on observing the path of least resistance, far outweighed anything that could have been scraped together by months of frantic, pointless trading inside the congestion. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern, computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. I have taught you the psychology of the market, the why behind the price movements. It is the timeless battle between fear and greed, hope and despair. Understanding this gives you the discipline to wait, to observe, and to control your own destructive emotions. But for the precise mechanics, for knowing exactly where the battle lines are drawn, how to measure the force of the buying and selling waves, and when to execute your trade with tactical precision, you need a more granular structure. You need the methods of my contemporary Richard Wyckoff. He was a master at reading the tape, a genius at dissecting these periods of congestion, which he called accumulation and distribution. He created a framework to identify the exact footprints of the large operators. I give you the discipline and the mindset, but for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. I have left the link to his channel in the description below. Use it to complete your arsenal. Now let us translate this into the market you see on your screens today. The principles are unchanging. Imagine a stock in the steel sector. Let's call it a hypothetical company, Consolidated Steel. For the past 6 months, its chart shows a price bouncing between $90 and $110. 90 is the floor, the support. 110 is the ceiling, the resistance. This $20 channel is the zone of conflict. Your first task is to recognize this as a no-trade zone. Your primary strategy here is patience. You do not try to buy at 90 and sell at 110. That is the amateur's game, a low-probability endeavor that racks up commissions and mental anguish. The real money is not made in the churn. It is made in the trend that follows. Your job is to become a detective. You set alerts on your terminal, one at $110, the other at 90. Then you walk away. You concern yourself with other opportunities until one of those alerts is triggered. Let's say one morning you get the alert. Consolidated Steel is trading at 111. The stalemate may be breaking. This is not the signal to buy. This is the signal to begin your focused analysis. You must ask a series of questions. First, on what kind of volume did it break out? A breakout on a massive surge of volume is a sign of conviction. It shows that big money is behind the move, aggressively buying up all available shares at and above the old resistance. A breakout on thin, anemic volume is a red flag. It often precedes a bull trap, where the price is briefly pushed up to lure in the unsuspecting, only to be slammed back down. Second, how does the price behave after the breakout? The most powerful confirmations occur when the price moves above the resistance level, and then, after a day or two, pulls back to test it. That old ceiling of $110 should now act as a new floor of support. Imagine an army capturing a fortress. They breach the wall, and then they fortify that same wall to defend against a counterattack. If consolidated steel pulls back to 110 and the selling dries up, if buyers step in and hold that line, that is your confirmation. The character of the market has changed. The line of least resistance is now demonstrably upward. That is your moment to enter the trade. You are not guessing. You are not hoping. You are acting on evidence. You are aligning your capital with the proven dominant force in the market. Now, we must always prepare for the possibility that we are wrong. The market is a master of deception. What if you act on a seemingly perfect breakout, and it fails? Let's say you bought consolidated steel at $112 after it successfully tested the breakout point. But then, a wave of selling hits the market, and the stock slices back down through 110, closing deep inside the old trading range. The tape is telling you something vital. Your thesis was wrong. The breakout was false. The line of least resistance was an illusion. In this moment, you have only one job: to cut your loss. You must sell the position immediately, without hesitation or hope. The novice will hold on, telling himself, it will come back. He is now praying, not trading. He has allowed a small, manageable loss, the cost of doing business, to potentially turn into a catastrophic one. A professional speculator accepts the loss as new information. The information is, the upward path is blocked. He exits, preserves his capital, and waits for the next clear opportunity. His ego is not tied to any single trade. Consider another scenario. You buy the breakout and the stock moves up to $120. It then begins to drift sideways again, in a new narrow range. It isn't going down, but the upward momentum has vanished. The powerful current you were riding has slowed to a lazy drift. What does this mean? It means the line of least resistance is no longer clearly upward. A new area of supply, a new wall of sellers has appeared. Your reason for being in the trade, a strong uptrend, is now in question. The prudent course of action is to sell the position. Perhaps you take a small profit. Perhaps you exit at break-even. The exact amount does not matter. What matters is that you are freeing your capital from a situation that no longer has a clear, positive expectancy. You are refusing to let your money get trapped in another protracted battle. Capital is your ammunition. You must keep it liquid and ready to deploy for the A-plus setups, not let it get bogged down in a pointless stalemate. Understanding the line of least resistance is the foundation of a peaceful mind in trading. It frees you from the tyranny of opinion. You no longer need to argue about whether a stock is overvalued or undervalued. Such arguments are the domain of academics and the crowd. The tape is the ultimate arbiter. Price, propelled by volume, tells the only story that pays. When you see a stock in a powerful uptrend, the line of least resistance is upward. It is too high and will likely go higher. To short it is to stand in front of a freight train. When you see a stock in a free fall, the line of least resistance is downward. It is too cheap and will likely go lower. To buy it is to try and catch a falling knife. Your task is not to be a hero. Your task is to be a pragmatist. Find the train and buy a ticket in the direction it is already going. Find the falling knife. Wait for it to hit the floor. Stop quivering. And then, Only then consider picking it up. The market is an ocean, and you are the captain of a small ship. You do not control the tides or the currents. A foolish captain will try to sail directly into a storm, his ego convinced he can conquer the sea. He will exhaust his fuel, break his mast, and sink. A wise captain studies the currents. He respects the power of the ocean. He waits for the favorable tide and rides it to his destination with ease and efficiency. The line of least resistance is that tide. Stop fighting the market. Stop imposing your will upon it. Learn to listen to what it is telling you. The tape tells you the story. Your only job is to learn its language. Stay disciplined.